Good afternoon, everybody. Welcome to today's webinar. We're going to take a little bit of a look at the market and see if we can make sense out of this thing. Welcome, everybody. And what do you, let's get an opinion here. What do you think? How many people think, A, Dan, I think the market's going up in the next couple of weeks. Just talking next couple of weeks. B, I think the market's going down the next couple of weeks. What do you think? All right, so this is your opinion. You can't be judged wrong. You got a 50-50 shot here, right? Now you got to make a shot. Take a shot, right? You're not going to get penalized, I promise. October is what? Historically down. What are the, and we started down, right? October historically is down. October is kind of your last big earnings period of the year. So you have those catalysts with the Fed, but you know what? There's catalysts every month, isn't there? We live in a time and age and history. You think there's going to be a month in the next 6 months where there's nothing going on in the world? What I'm going to be working on today is mostly on, I'm just using the ThinkorSwim platform, TD Ameritrade ThinkorSwim platform. I'll kind of explain it for those who aren't familiar with it, but I got to use something, right? I'm not going to use PowerPoints today. I just thought we'd look at the market, tell you what I'm looking at. Maybe I'll put on a few trades, and we'll go from there. All right, so how do I look at the world here? This is a ThinkorSwim chart, and I'll just say, so what I'm going to do is, here's how I'm going to do it today. I'm going to tell you how I look at the world, but I'm going to give you some good news. I don't know where the market's going. Let's jump in here and let's look at this. So first I'm going to do is talk about the market a little bit. I'm going to talk about step one, the market, and the goal is to get a trade. Talk about the market, talk about how I look at the market, talk about how we look at an options portfolio, look at some criteria, and then kind of dial down a little bit, start from 30,000 feet up and dial down a little bit into looking specifically at the price level of SPX, looking at the VIX and the volatility levels, how fast the market's moving, and then I'll dial into a couple trades based on our analysis. How's that? And maybe we'll look at a couple earnings or something from earnings. But I want to give you the process, right? Instead of just jumping in and just doing a trade, and we don't even know why we did the trade, right? How many of you want to know why you do something in the options market? How many is it important to you that you actually know what you're doing? Is there anybody out there that it's important to you to have a clue on what you're doing? And how many of you say, you know what, Dan? How many of you have the mentality, show me the money? I don't care. I just want to get a newsletter, have them tell me what to do and make money. How many is that your motive? You just want to show me the money. Unfortunately, the reality is there's not many out there, right? Wouldn't it be nice? I would like that as much as you, right? I would love to believe those commercials after you've had a pizza and you're up at 1 in the morning that shows the guy in the Ferrari and he made $2 billion in an hour, or he can make me X amount per month. I'd love that, right? I'd love that. But if you really believe that's out there, there's a friend of mine who works at Magic Kingdom. You can come there and you can live there, Magic Kingdom, and whatever you think will happen, will happen. All right, so let's jump in here. First of all, how do I look at life, right? So first of all the trades that you guys do, first, I need structure. Where does this fit in that everybody does? So first of all, we have a long portfolio. This is a 1-year price chart of SPX, as you've heard me before. A long portfolio. I have 3 parts of a portfolio that we trade long portfolio income and spec. And again, this is a 1-year price chart. This is a 50-day moving average. This is 200-day moving average. This is a 50-day moving average, this green line. Simple moving average. This is the implied volatility here. Again, these are over a year. This is the implied volatility, which is going to be about the same as the VIX, since we're looking at SPX. This is called an 8-day Wilders. And all that is telling you, it's showing you the width of the high and the low each day, right? So this is more something I look at for doing short-term trades, like 7 to 15-day trades. It tells you how bumpy it's going to be, or it is, how much turbulence. And so we're looking at the ATR is just, again, it's a measurement. It takes the high and the low of SPX every day. So as the range gets bigger, it's basically telling you it's going to get bumpier. So as you see, like here's the correction when we were down 20% on Christmas Eve 2018. The candles are getting bigger, and you can see these candles. So there's a much bigger range in SPX for the day, and you can see the ATR was jumping up. You could see in the end of July, beginning of August, we had that about 5% down move in the SPX, right? And those candles get bigger moves to the downside, the ATR shoots up. So as we see a higher ATR, it's basically like the pilot saying, we're going to have a lot of turbulence. We're going to take some precautions. So we're trying to navigate through these markets, not so much focusing on which way the market's going. I think it's useless. But more, as I said, use a lot of analogies. How are the weather conditions? I live in Chicago. How are the weather conditions? That affects my driving. Or if you're a surfer, how are the waves? You know, certain levels of waves you can surf, certain levels of waves maybe you can't. Certain weather conditions in Chicago, you drive 60, 70 miles an hour, but as it gets in February and there's snow and ice, you're going to drive 40. So we're using a lot of these indicators, how we navigate through this stuff, right? So long portfolio is just taking the view, I am an investor. I think the market's going up over time. It's the investor. These are all intentionally neutral to bullish positions. What goes in here? Cash secured put, covered right, put credit spreads, long stock, long mutual fund, long underwear, everything you want in there. It's neutral to bullish. Income portfolio says range-bound trades based on probability and time decay, right? That's probably the biggest part that we do. And those are iron condors and butterflies and calendars and double diagonals and that type of thing. Again, this is the view of an investor. This is kind of range bound based on probabilities and decay. And then everybody's favorite, speculative. You wake up in the morning with your pajamas on and you say, I have an opinion based on technicals, based on fundamentals, based on bad pizza, based on somebody's system, based on whatever. But it's my opinion. And so, you know, if you look in this, you know, just give an example, towards the end of December, when the market was getting beat up and we were 20% down, right? We were like 60% long portfolio, 30% income at best, and 10% spec. I mean, it's just give you an idea of allocation. You say, why? Well, if you're a long-term investor and the market's off 20% off its highs, which it was here in Christmas Eve of 2018, yeah, you would allocate more towards your long portfolio. Does that make sense? Just in a general conversation of allocation. Somebody say yes. I don't need many yeses to encourage me. Somebody say yes. There you go. Thank you, Dino. My favorite Greek says yes. All right. If you look right here, what are our allocation percentages in the market today? Right? Today, with the SPX at 2920, and the VIX at 1881. This is VIX. This is SPX. And the ATR is at 37. So we're still doing all of these trades, but with SPX at 29.27, let me ask you a question. 29.20, how far are we off the all-time highs in the history of civilization? All-time highs in the history of our universe has been 30.27 in the SPX. Right now, as we speak, we're 29.20. So we're 100 points off of the high in the history of the universe, even before Cleopatra, right? So 107 divided by 30.27, we're 3% off the highs in the history. So let me ask you a question. We're 3% off the highs in the history of the world. At this level, how many of you would be comfortable being 100% in with the long portfolio neutral to bullish? 3% off the highs, yes or no? How many of you would be totally comfortable being jacked up with most of your capital, only 3% off the highs in a historically down month? No. So what would we do? Contrasting what we were in January of this year because of the down market now, and again, this is just something to get a big picture view on maybe 100,000 hypothetical portfolio of options. At this part in the current market, long portfolio, income, spec, right? And I'll put cash, right? I might be long portfolio instead of 60 with us 3% off the highs at the most, right? 30. Cash, it might be, I'm just throwing my thoughts, right? We could argue these numbers all day long. I might be 20% in cash. Spec, maybe 10%. And then maybe 40% in income, right? And again, we could tweak these, but again, you need some semblance of sanity, right? Now, so we've gone from a big picture perspective. So what would we be looking at today? And specifically, I'll look at the income part of the portfolio. From a volatility, right now as we speak, VIX is 18 to 74. In the last couple months, August and September, we've been in an SPX range of 28. I don't know, what's the lows here? 28. I'm winging this. What's the lows here? 28, 25, 30, 20. Last couple months. Is that about right? SPX range the last 2 months. Yes? Am I close? 28 and a quarter, 30, 20, something like that. Is that pretty good? Yeah. So if that's the case, what has the VIX been during that period? Some volatility. The VIX has been in that period probably 14, roughly. I'm not just taking the high tick, 22. Well, that's a good question. Chuck White of the famous White family says, Dan, how do you define income? Good question. Since long portfolio, income, and spec, it's all income, right? Agree? If we make money in any of these parts of the portfolio, it's income. Agree? But I would look at more, so it's all income, but I would look at when I define monthly income or income trading, positive theta, right? Positive theta for the most part. That make sense? So in other words, what am I saying? I'm an insurance company, right? What do you mean? I'm selling options that decay more than the options I'm buying against it. Okay? So when you buy an option, when Chuck White buys an option because he thinks it's going up, what happens if it doesn't go up when Chuck wants it to go up? That option decays, and you hear this sound. He loses money, right? Or if it goes against him. We're starting out with trades that have positive time decay and either probabilities and decay in the favor. And the only way we lose money is if it moves too far in either in one or both directions. Does that make sense? I don't know if I gave it a good enough. So we don't need price movement to be profitable. We're saying we think it'll be in this range, and within that range we make money. So we're not the typical way in option. You know, a lot of the information you read out there for making money in options is what? Unusual option volume, and we're going to buy a call and buy a put and all this. It's all speculative, right? And all of that is low probability occurrences. Maybe at the end of the year you'll have enough for a Starbucks coffee, maybe not, right? But this is more probability time decay, and it's based on the center of gravity here is something called risk management. Who's heard that term, risk management? Kind of a weird term, risk management. All right, so with the SPX in this range, in the VIX here, and ATR, again, giving you may not understand everything I'm saying today, but I don't feel right if I'm not giving, I don't want to come here and not give you at least reasons why I'm doing what I'm doing, right? Instead of saying, you know, again, it's not that difficult. VIX is the ATR we said is 37. So because there's been a lot of bumpiness, a lot of turbulence with big moves in the market, the ATR is high right now in the SPX. So I'm staying away to an extent on short-term trades, and I'm basically focusing because the volatility is in the upper end of the range, right? If this is the range of VIX over the last couple of months, you know, the upper end of the range to me might be 19 to 22, even though we haven't touched 22 much, it's more like 21. But so when we're up at these levels, what am I looking at today? What are strategies I'm reckoning in the community? Short Vegas stuff that benefits with the volatility, goes, you know, reverts back to the mean. Butterflies, iron condors, further out duration. Again, ATR, which I talked about a little bit at the beginning. Wayne, show up at the beginning of the webinars, please. Please show up at the beginning of the webinars, or you will not get your free hamburger with French fries. Average true range is, you take, when you're looking at these candles, the ones with the bigger candles, right? Average true range is taking the distance between the high and the low in SPX every day. So it's telling you how much movement. The bigger the candle, the more movement in SPX for the day, right? So all it's giving you, Wayne, would be, I'm driving on the road in Chicago. I'm driving on the highway 60, 70 miles an hour. That's the way we go. Right? Well, Wayne, what are my indicators when there's more turbulence, when the snow and ice kick in? And if I go 60 or 70 miles an hour when the snow or ice kick in, I'm going to crash. So I have to say, when there's X amount of snow or ice, I slow down to 30 miles an hour. And what we say is when these candles get bigger and the ATR will start going up, when the ATR hits a certain number, we're backing off of the short-term trades. Why? same reason I can't drive 60, 70 miles an hour in ice and snow in Chicago, right? Right. So we're not, in no way am I saying at any point here which way the market's going. I don't know. But if I'm of sound mind and body, just like a surfer in the ocean knows when the waves go from 4 to 8 foot, a driver in Chicago knows when it goes from 1 inch of snow to 10, right? If you have your eyes open and you want to pay attention, you can do it. So are we aware here? Is it public information when the range in SPX, which is normally 25 to 40 points a day, when it goes up to 70? Is that public information? Can you know that? Can you know that? If you want to know it, right? And so all we're doing in our income trades, when the turbulence gets too much, when the snow gets too much, when the ice gets too much, when the waves get too much, and we look at little easy indicators, we back off, that's all. If you look here in the correction, right? The correction, very early in the correction, on October 10th, which would be about here, right? We got warning signs. What were the warning signs? We like VIX between 12 and 18 to do most of our income trades, right? Just like pilots like a certain environment to fly. And we like ATR in the SPX less than 27. On October 10th, very early in this 20% correction at the end of the year, what happened? Right? Was I worried about a correction? No. ATR went over 27. Look, you can look yourself on October 10th, and VIX went over 18. So it's telling me, hey, Dan, you've got 8 inches of snow and you got ice. If you keep going at 60, right, you're going to crash. So did I know which way the market's going? No. But things were getting too much turbulence. So what do pilots do when there's a lot of turbulence? A lot of times they'll fly around it if it got bad, right? Usually they're just warriors. They go right through it. Lee says, why is VIX near 19? Would you be inclined to do a 60-day or broken wing butterfly? Well, when it's at 9, well, vols are higher. I don't know what let me see if I read the question right. Why would I do a 60-day? I didn't say 60-day, but maybe a 30 to 45-day. When the VIX is higher, as long as there's some stability, I'm going to go further out and do short Vega trades. Why? Well, you're looking for a reversion to the mean, and with the VIX 19 or 20, that means the SPX is going down 5, 6% or more. So by getting duration, it's going to save my bacon with big price moves. I'll give you an example. During this period of, how many remember the volatility in August? Is anybody living in the real world in August? Here's August. You see those big candles? Does anybody remember that? That was a whole 2 months ago, right? So we looked at the range in here, 28.25 to 29.45 roughly. And the VIX was between like 16 and 21, 22, much higher. So all we were doing here was selling, doing iron condors and butterflies at like 2021 volatility, and they all did fine. You got a lot of protection against price moves, and you're selling volatility in the upper end of that range. This may seem Greek to a lot of you, right? Each of you might have different ways that you've been taught, or maybe how you've learned options. It's just how I make sense of things, right? I think 90% of the folk in the options education world are still directional, right? Why do they do it? Because you guys buy their goofy newsletters. Again, I don't have to be politically correct here, right? Can I give my opinions? Yeah, most people, you buy their goofy newsletters. So, you know, whether it's based on unusual option volume or based on, you know, I think the stock is going up or down. And I'm not saying there's not some of that, but I think that's a tough thing over time to pick the direction of the market on a short-term basis. Now, in the long portfolio, that's different. We're saying, hey, we're neutral to bullish over time. If you like Apple over the next 3 years, I'm going to do put credit spreads every 2 weeks till I'm 93.5, or I turn bearish on Apple. But it might, it's the long portfolio is long and is long-term bullish. All right, so let's look at a couple trades. First, I'll look at an income trade. So what would be a type of trade that I would do? So I'll just throw one, we'll look at an iron condor, just because we talk about butterflies way too much. What happened here? We'll explain this, right? So I'm going to go out for an SPX, and I'm going to look at an iron condor. And I'm going to look. Any question? I mean, again, we're just talking, right? If Joan Rivers says, let's talk, we can't explain everything in 20 minutes or 30 minutes, but you at least get a little bit of my thinking, what I'm doing here. Somebody say yes. Do you have any questions? All right, so what we're going to look at is, I'm just going to go 44 days out to November 22. 44 days out to November 22. I'm looking at an iron condor, and I'll explain this to you. Even if you've never done one, I'll kind of explain it. So an iron condor, and I'll put this on. An iron condor is selling an out-of-the-money call and an out-of-the-money put. What's that called? What's that called? Sell an out-of-the-money call and an out-of-the-money put. What's that called? Somebody's got to know. A strangle, a short strangle. The foundation of an iron condor, the reason you do an iron condor is to sell an out-of-the-money put, out-of-the-money call like an insurance company, and your hope is that the underlying does not go past the short strike of your call or put. And usually there's probabilities, because you're selling it far enough out of the money, that it won't, right? And the success of making money on an iron condor strategy is two things. Number one, putting it on consistently over time. And two, managing it when it moves too far, right? Having a plan that makes sense. Most people don't have a plan, and when it goes against them, they do like Dorothy and Wizard of Oz. I want to go home. There's no place like home. There's no place like home. So here's an example of an iron condor today, and then we'll talk about it. I haven't done anything yet. So again, 44 days. So I'll just use an example here. I'm going to go sell again, this is an update. So the VIX is down, right? And it's still pretty high. Normally I like doing these on an up when the VIX is up, but again, with these levels, 18.72 on the VIX, still a little bit high. So I'm going to go in and sell just for this, many different ways to do it. So the way I'm doing it, it's not the way Dan does it all. I'm just giving you an example of an iron condor. There's many ways to do it. One isn't better than the other. There's pluses and minuses. So let me give you, I'm going to sell a 10 delta call, which is the 3080s. I'm going to sell a 10 delta call, which is the 3080s, and I'll explain this. And I'm going to do 5 wide. I'll make it a cheaper iron condor today. Again, the wider you make the width of the spread, the more expensive it will be. But I'll just try to do a cheaper iron condor, 3085, and I'll explain all this. On the put side, I'm going to sell about a 16 delta, 2710 put, and I'll explain this again. So my goal is you're an absolute expert in a half hour today. What do you think? Is that realistic? No, but we'll give it a shot. Here's where we're at. How's that look? So Dan, what are you doing here? So what I'm doing here is SPX is, as we speak, about 29.23. I'm doing a November 22. So what's my setup? My setup is about 44 days out, duration, 44 days out. I'm selling the, no, 22 expiration, I'm selling the 3080 call, which is about a 10 delta. This will be recorded. So how many points out of the money is my short call? How many points roughly out of the money is my short call? How many points roughly out of the money is my short call? Stuart says 157. Because I'm not as good as math with Stuart, I'm going to round it to 160. 160 points out of the money at 3080. Now let me ask you a question. In the history of the universe, have we ever traded up to 3080? In the history of the universe, and Pluto, and if I include the history of Pluto and Mars, have we ever been anywhere near 3080? No, but that's what I'm selling. On the downside, I'm selling the 2710 put. This is the foundation of what I'm doing, selling the out-of-the-money call and put. Probabilities and time decay in my favor, as long as we don't go above the short call or below the short put. So I'm selling the 2710 puts at a delta of, in this example, 16. What does it mean in English, Spanish, or Greek to sell a 16 delta? It means there's only a 16% probability in the next 44 days of this trade that we're going to close under 2710. And on the upside, there's only a 10% probability we're going to finish over 3080 at expiration of 44 days. Right? And we're getting a credit, about $1.25 credit to do the call credit spread and put credit spread. The risk, if SPX goes to 0 or 12 billion, it's $500. The risk, the difference between the spreads, less $125 the credit. So for every one of these I do, at my brokerage firm, I put up $375. You with me? You with me? If SPX goes to 0, or SPX goes up to $1,200 billion, whatever that is, $375 is the most you could possibly lose. This is the risk, less your credit. You with me? Somebody say yes. Dan, I'm with you. Yes, thank you, Patrick. So, but the reason we don't just sell the put and the call, what's the reason we don't just sell the call and the put without a type of a hedge? What's the reason? What's the reason we don't, that we just sell the call and that we don't just sell the call and the put? Well, limit loss. But if you go sell an out of the money call and put naked at your brokerage firm, you think you're going to do it for $375 and in a regular account, right? I would bet if you just sold the call and put without any wings, and I'm not talking about a portfolio margin account, that's a different thing, just a regular account that you'd open up at your brokerage firm, what would you think something like this would cost? What do you think? What do you think? Just selling out of the money call and put. What do you think? Give me a number. I'm thinking about $35,000 to $50,000. Am I far off? If you go into ThinkorSwim or TD Ameritrade and go and attempt to do this, maybe someone could go and attempt to do this. Yeah, I think $30,000 to $60,000. Robert says, did you say why you're doing 44 days versus 30? No, I just said I want to do, because the market's been choppy, which is measured by the ATR, I want to get a little more distance, so 45 days is about right. 30 is not horrible. So anyways, so you could see now with the VIX right today at 1855, you might say, Dan, what's the difference doing an iron condor 44 days out or whatever this is? I think it's 44 versus if the VIX was only 13. What do you guys think the difference would be? What benefit are we getting doing this trade today? For a 44, 45-day trade, if VIX was 13 instead of 1855, instead of getting, so we're getting versus the current price, 213 points. So in a 13 volatility, would we get 200 points out of the money for a 16 delta put 44 days out? No, we'd probably get half of that. And if the VIX were 13 on the upside, would we get 160 points out of the money for a 10 delta call? No, we'd get probably 80 or something. Big difference. And we probably wouldn't get as much credit. So the higher the volatility, you're getting more protection if there was a move. It's like a warm blanket in the winter. So in this environment that we're in right now, as long as we're between 28.25 and 29.50, right? Unless we blast under 28.25, around this volatility level, 19 to 21, I think is a pretty decent number in this range. Does that make sense? And so we're still in the setup. I'm not going to get into adjustments today. It's already gone 45 minutes. I'll just kind of wind it up today. I'll probably come next Wednesday and do this again. Enjoy this. This is just talk strategies, but I'll give you a profit target and a max loss. So again, so I put this on, I'll put this on, and then next week we can kind of talk about this a little bit, but I will, again, I don't have time for adjustments, but let me just do this trade. And then, so this says, and I'll just give you a basic plan here. Yes, the webinar is recorded. So I'll do the trade live, just give you a basic plan. I'll talk about this next week and then probably another strategy or something. And then I'll just talk a little bit about commissions here in a second. So this says, this has been in a range with SPX at 29, close to 29.23. This range has been, the credit on this has been between $1.15 and $1.25. And since it's a credit, I want to get the upper end of that range, at least start. So the range is $1.15, $1.25. I'll start it at $1.25 credit. Well, I didn't say this. Well, let me get it filled and then I'll talk about the Greeks and stuff like that. Let me just get it filled. So $1.20, hit the nuclear weapon button, send. And so you can see here, I'm trying to sell it for $1.25 credit. And the range was $1.15 to $1.25. So I start at the upper end of the range. I'll work my way down a nickel. So now I go to $1.20. Hit the nuclear. I didn't want to go to $1.15, but we'll just see here. So again, the most I would go, the lower end of the range is $1.15. Again, SPX is 10 times bigger than SPY. So 1 penny, 1 cent in SPY is like 10 cents in SPX. It's nothing, right? Or caving in 10 cents in SPX is like 1 penny in SPY. So I will get executed at $1.15. I would bet you $2.22. So let me just get it so I can at least talk about this. Cancel. $1.15. We'll get executed here. All right, so we get filled at $1.15. It probably could have got 120 if I was more patient, but $1.15. I wanted to get this on. And now let's talk about it. So we'll just talk about it for about 5 minutes. I don't want you to, and we'll go from there. A question from Bill says, Dan, is it better to do 3 contracts wide or 1 contract 10 wide now that we have no commissions? Again, we do have commissions. It's just, and I'll get into it in a second. Again, let me ask you, I don't want to, Bill, let me hold that thought. I don't want to go off on a tirade until I finish with this before I close on commissions. So we did it for $1.15 credit. So here's our plan. Right now we're at 29.23, and I'm not going to get into adjustments today, so I'll just give a basic plan. We sold this credit spread for $1.15 credit. We had $500 of risk. These are 5 wide credit spread. 500 minus my credit of $1.15 gives me $385 is the cost of this one. Agree? So small trade. Someone wants to do small. $385 is your risk, right? So on this, if I'm trying to make, let's round this to $400, just because I can do math better on 400 than 385. If I'm trying to make 10%, say I'm trying to make 10% on this, where do I put, if this is where I sell my credit, at what price do I buy this in to make 10% and round it to 400? At what price do I buy in this spread to make 10% of my capital over the next couple of weeks? 10% of, if I round this to 400, 10% of 400 is 40. 40 from $1.15 credit would be, so I put an order in for a profit of 75 cents debit. If I pay 75 and I sold it at 115, I make $40 divided by 385. That's it. You with me? About 10%. And again, like in any high probability trade that I'm going to win a lot more than I lose, I want the probabilities to work, but I'll put here my max loss. Where do I get out? Because I'm going to do, again, here's the assumption. Unless in a few situations, I'm going to be doing this every week or every 2 weeks until I'm 103 or 3, whichever comes first, right? So I'm going to win a lot more than I lose. I just have to limit the losers. Isn't that it? The most important thing in being a successful iron condor trader has nothing to do with the Greeks. I'm so sorry to tell you that. All it has to do is don't tell anybody this. Promise. Don't lose much more than you make. That's it. And be consistent. So if I don't want to lose more than 15%, I want to give myself a little bit more room, let the probabilities work. 15% of 400 would be about $60. So if this credit goes up to $1.75, what's that song? They say it's sports games. Hit the road, Jack. Dun, 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 hit the road, Jack, or whatever. So if we go to $1.75 and it's the upside, just take off the call side. If it goes to $1.75 on the whole spread, it goes to downside by the put side. That's it, right? So I'm just giving you a very quick and easy on iron condors. You do this consistently every week or every month until you're 232 years old, and you keep your losers under control. You'll have a nice little business, but the discipline part is hard. Now, I'll conclude that for today. Let me get into a quick tirade on commissions. Right? How many of you, when you look at advertising on TV, right? Wonderful advertising during TV or whatever, how many of you have a hard time reading the small print on the bottom when they give you such a good deal? Whether it be in the newspaper or TV, how many of you, like me, have trouble reading the fine print when they give you the awesome deal like a free car or a free house with a maid or whatever? How many of you read the small print? Let me ask you a question. In this, first of all, let's just talk for a second on free commission. I'll give you my 2 cents. And then I'll give you my other 2 cents. So first of all, to me, and again, I'm giving you my thought, it's not worth anything, so it's probably not worth anything. Here's my thought. Brokerages, why is Tom Sosnoff where he is, and Dan Sheridan where he is, and John Najeri, and a lot of these guys in the education business? Because the business stopped being profitable. It was tougher to make a living without taking a lot of risk for a lot of market makers, so we all left around the same time. The big reason we left, one of the biggest things that made the business unprofitable is payment for order flow. In other words, one of the advantages of being a market maker on the pit, we could buy on the bid, sell on the ask, kind of like a bank, right? You go in, give your bank $10,000, they give you nothing, they loan it out at 2%, right? They're happy. They could build big buildings, give free coffee, do the whole 9 yards. So when payment for order flow came, which I wasn't sure it was legal, I'm still not sure. I don't know if the industry knows if it's legal, but it's like the prisoners started running the prison. So now ThinkorSwim or Options Express or any other brokerage firm, they go to the CBOE and they say, look, if you want our orders, right? If you want all our business, pay us $1 a contract. So for the last 20 years, these brokerage firms have gotten $1 a contract. So like when Robinhood comes in 8 years ago and says, we're doing 0 commissions, how are they making money? These firms make money 2 ways, right? They're still making $1 a contract, right? Did you read the Wall Street Journal article? I think Robinhood sells their order flow to Citadel, owned by the richest guy in Illinois, Mr. what's his name, Griffin. And so they're making money. So the problem right now with 0 commissions is the brokerage firms were charging you $50 for a chair that was only worth $10, and now they can only sell you the chair for $30, right? So are they still making money? Yeah, right? They're still making good money, but not as much, right? So brokerage firms make their money off you 2 ways, right? If Bill Kelly or Stewart puts $200,000 in TD Ameritrade, they're going to give them lower interest rates than they would get at money market or anywhere else, right? They give them basically nothing, and they'll lend the money out at 2%, and they'll make some decent money off them, right? Even 2% on $200,000 is pretty good for them, right? So it's been rougher on brokerage firms from what they're used to because interest rates are lower, so they can't goose you as bad, right? So I don't mean to sound negative, but I don't know how else to say it. But, you know, they're making less off the long interest, and now with rates coming down, they're just not making as much, but they're still making that payment for order flow, and I don't know all the whole model. Does that make sense? No. Here's the thing. Here it gets tricky. Look at your commissions, and you need to look at the different fees when you go. Free means differently to everybody, right? In other words, Dan Sheridan's definition of free could be free, but every week you have to send me Portillo's hot dogs and fries for the next 2 years, right? But I'm not charging you commissions, but it's free. Now, free could mean free, but if you trade SPX, free means to a lot of people, free is free, but you're going to pay the CBOE fee of 65 cents a contract. In other words, if any of you can show me that you're doing SPX for 0 without any fees, I will send you Portillo's hot dogs within an hour because no one's going to show me that. Why? Or Italian beef if you like beef. Because free to TD Ameritrade and SPX is your free will be 65 cents a contract, right? They're charging the CBOE fee. Now, I haven't checked on TD Ameritrade today if I did Apple. I think Apple would be free, but I haven't looked to see if they're charging me any fees, right? So check your fees, ask what your fees are, right? They could charge you a fee based on the chief executive officer wants to buy blue socks every week. You know, that's what the fee's going for. So all I'm saying is be careful what free means, especially in SPX or RUT, right? Those are indexes and they have some fees attached to it. You will not get free on that. But stocks, maybe it'll be free. But the other thing, does that make sense? I'd love to talk more. I'll come back next Wednesday. We'll look at this. We'll talk about this Iron Condor. We'll talk some more about commissions. We'll talk about other stuff. If there's anything you want me to talk about next Wednesday, or questions maybe you didn't get a chance to ask today, just send me an email, Dan@Sheridan Mentoring. I'd be happy to help you. But again, this is recorded, but just free is, again, I mean, I've got a lot of friends at the different brokerage firms. Tom Sosnoff, different people. I mean, they're good people. But they're in the business at the different brokerage firms. And it's okay. They're not non-for-profit, right? John Thompson says option trades are now 65-cent flat regardless of the vehicle. Wait a second, John. So you're telling me a TD Ameritrade, if I trade Apple, it's still 65 cents a contract? Because there's no CBOE fee on that. Is Apple 65 cents a contract? Because TD is advertising zero. Unless I didn't read what are they charging you 60? What's the commission on stock options, John? What fees are they charging you, John, on stocks? I'm not talking about SPX. SPX, absolutely the CBOE fee, but I'm talking about if you do options in Apple or options in Costco or options in Amazon or stock options. All right, let me look. Here, folks, I'll be a guinea pig. All right, let's do this again. We already did this. How about if I do it again? Let's look. I'm sorry. Why didn't I think of that? So let's do this Iron Condor again. Confirm and send. All right, so let's look at this. So they're charging me cost of trading commissions. And folks, so I'm doing an Iron Condor, 4 contracts. You guys with me in SPX? I'll be the guinea pig. I'm doing 4 contracts. I'm at ThinkorSwim, TD Ameritrade, 4 contracts, Iron Condor. So what's my commit? So 4 contracts at 0 would be 0, but let's look at cost of trading including commissions. So my credit, they're looking at a credit of $1.20 minus $2.60. Agree? So they're charging me $2.60 commission for 4 contracts. Did I read this right? Cost of trading including commissions. My credit of $120 minus $2.60. So my credit would be $117.40. So what's $2.60 times 4? No, I'm sorry. $2.60 divided by 4. Oh, well, there it is. Okay. So 65 cents. They're charging me the CBOE fee 65 cents. Well, let's go to Apple. I'm just curious here, folks. So let's say if I do an Iron Condor at Apple. So CBOE is, or the SPX at TD Ameritrade, they're charging me off the street 65 cents a contract. Let's go to Apple. Apple, I'm going to do an Iron Condor, sell Iron Condor. All right. And let's see what they charge me. This will be the test. Now we're in stocks because you have CBOE fee in the SPX. So let's say I sell the 230 call. I buy the 235 call. I'm just going 2.5 points out of the money. And then I sell the 225 put, and I buy the 220 put. I'm in the OC 18 expiration. So it's a 9-day Iron Condor. The graph looks like that. And so I'll just put it at 285 credit, a little bit above where we're at. Confirm and send. So again, the credit is 285. minus, they're charging me for 4 contracts in Apple, 260. Wait. Am I doing this right? Credit 285 minus 260, right? So it's $2.60 divided by 4. Yeah, you're 100% right. So I don't get that. Why are they charging you 65 cents a contract in stocks? I don't get it, but they are. Thank you, John. So John Thompson saying if I bought 1 share or 100 shares of stock, right? Here, let's go do that. Delete. So if I go in to buy, I've never bought stock in the account. And this, how do I buy stock here? I've never bought stock. I've only done options. Well, Kevin says stocks are free. Okay, so stocks are free. So 65 cents again. All I'm saying is you've got to look very close. Somebody said there are somebody free, but it's gone to 65 cents. It's just a shame. Why can't people make things simple? Just it's 65 cents. 65 cents is a good rate. Folks, let me just tell you, as of a month ago, Sheridan Mentoring, we had $1. Well, let me just say that. You know what? Our rates have gone up. Tell me I'm wrong here. My rates have gone up. There's people in Sheridan Mentoring. Correct me if I'm wrong, John or Dino. Sheridan Mentoring's rate that we've had negotiated with TD for a couple of years, and mainly it was for SPX, $1 a contract. So if I do an iron Condor 4 contracts, okay, it costs $4. Okay, so rates have gone down. So now I'm paying for, that's with the CBOE fee, right? We were $4. So we were basically paying 40 cents a contract. Or we were paying because the CBOE fee is 65. So it is cheaper. Instead of $4, it's like $2.65. I got you. So it is cheaper these days, but I just don't get why TD is charging 65 cents for Apple contracts. Oh, is that where it is, Kevin? Okay, so if I right-click on 227, I buy 100 shares of Apple at 227.47. So let's just go lower so I don't get it filled right away. Confirm and send. Cost of trading, yeah, $22,725 plus 0. So stock is free. Let me ask you something. But is it free? So let's say you go buy stock and it's free. All right, and you're going to have 100 shares of a $22,000 stock. They're charging you long interest on that stock, aren't they? You're still paying for the whole 22,000 stock. You're going to pay for that, aren't you? We did when we were trading. My guess is you are. Anyways, well, folks, I better go here. It's interesting. I'll be back next Wednesday. We'll continue this trading with Dan, solving life problems with Dan. We'll go over this again. Again, if you have anything you want to talk about next week, questions, send me an email, Dan@Sheridan Mentoring. Have a wonderful day, everybody, and we'll see you later. Thanks.